Okay, Jay here. This is smarthelping.com. We're talking about a battery recycling plant, brand new financial model. Remember, you could download them all at smarthelping.com, link in the description. Let me go through each tab really fast, and then I'll do a more detailed explanation. So, global control, executive summary, sources, uses, feedstock, big part here, forward pricing, OPEX, OPEX 2, CAPEX, construction loan, operating loans, cap table, startup cost, terminal value, monthly detail, annual detail, just kind of cash flow analysis, visuals, income statement, balance sheet, cash flow statement, and that's pretty much it. Okay, so let's go into it. You'll start by only editing cells in yellow, and keep in mind all of the cells or the numbers in here are arbitrary, meaning that I haven't researched what the inputs are. That's what you'll do with your specific scenario, and all the cells in yellow are editable. Now you can edit anything in the model; it's all editable, but all the yellow cells are input cells. Um, so company name, we'll start. We'll just call it batteries 1, 2, 3. Forecast period, you could define how long you want it to go for. It doesn't have to be 120 months, it could be 60 months or what have you. Include terminal value, yes or no, and then EBITDA multiple. Now, note this EBITDA multiple will include any fixed assets at sale. Um, and then the cost basis or the book value of the assets will reduce off as far as tax goes for your exit cash flow. First month of forecast. This doesn't really affect anything; just displays at the top of the financial statements. And start month of operations. This is just going to define when depreciation starts, based on your fixed asset purchases. This is the earliest that they could start. Cash sources, investor equity, owner equity. This all pulls from other tabs. Just total debt and equity calculations here, and then see your tax rates, and then check summary to make sure all the different financial statements match up with each other. These should always be zeros. Executive summary tab, so high level um, view of all the financials. You got all your different revenue types, uh, SG&A, your direct costs, EBITDA, EBIT, other cash flow items, sources and uses. We can see the minimum equity required, loan proceeds during the stabilization period, net operating income if positive, and then uses, your working capital effect of receivables, capex, other initial cost, debt service taxes, and net operating income if negative. These will always equal each other. Now, the big tab here. So let's actually talk about the business. So, battery recycling. What I've done here is you've got four different sources of batteries or battery like things. So, and you could edit these, but I just did four. I did electric vehicle batteries, LFP batteries, gigafactory scrap, and consumer electronics. Now, each of these you can do. You can define the feedstock, so the amount of feedstock you're taking in from each source, and then you could do it manually for the first 2 years, and then define a growth rate after that that applies to each. Or if you don't want to do that, you could just manually put in all of it all the way down to the 10-year mark for how much tons of feedstock you are having come inbound each month. So we have four sources. Now, each source has different attributes. The first attribute is how are you paying to acquire it, or are you getting paid to acquire it, or are you paid to process it and give it back? So the first option is you don't own it. Tolling means that you're getting the feedstock from a source, they're paying you a fixed fee, and then you're returning the black mass that's resulting from breaking it down. And so that's just a fixed fee model. You don't own the material. The last two are where you own it, and the gate fee means revenue. So this is like they're paying you to take the material, and then you own whatever you make it into as well. And you could define the percentage of that as well as the top one. And then the third one is where you're actually paying to acquire the feedstock, and then whatever you can process it, break it down, you own that, you can sell it off. Okay, so we got four sources, three types of ways we acquire it, And then for each of these sources, we also have a bunch of stats about it in order to configure our factory. And all of these things here are only going to apply to these bottom two. The tolling, just you get the fee, you return it, nothing else really happens from there. There will be a cost, a direct cost to this, obviously, because it costs to process it. So we'll have that on the OpEx 2 tab, but we'll get to that later. But for these two, we have to define, of this total feedstock, we can do a black mass yield. So that could vary per type. You know, consumer electronics are going to be different from electric vehicle batteries. So we can define how much black mass tons we're getting out of the tons of feedstock for each of these types. Here I just did 0.45. You also have a moisture and purity discount, which will further reduce the amount you get. And then as a result of this process, you then have black mass. So the black mass, you can do two things. You can either resell it directly, and there'll be a price per ton of that, which we've got forward prices to define all of the prices and everything here. Or you might refine the black mass further and go down into the actual metals and resell the metals. And you could do a percentage of the black mass that is subject to doing that activity. And then, so once you have that defined, you keep going down here, and we want to define for the black mass that we're going to refine ourselves. There's some outputs here, up to 6 different products. So nickel, cobalt, lithium, manganese, and you got 2 other options. And you could put the percentage of the total tons of black mass that you process end up being nickel, cobalt, etc. And that could vary, obviously, for each of the sources, because they could have different yields. Electric vehicles might be different than gigafactory scrap. So you define your percentage yields of the main metals. This is probably going to be your biggest income stream, most likely. And the prices of those, again, are on the forward prices tab. For those, it'll be right here. You can see black mass refinement output. Up here was the direct sale black mass for each of the 4 types. And note, the reason why I did different prices is because the black mass you get from, again, EVs could be different than giga scrap or consumer electronics. So you can define the price per ton of black mass sold directly there. We got the metal refinement, and then as we go, and then you've also got tolling and gate fees up here. You can define those were for these top 2 items. So I just took the starting amounts here, and then you could update them over time if you think they're going to change. Anyway, so there we're at product yields from black mass. We've got byproducts from refining the black mass. So this would be other things, graphite, aluminum. Now some of this could be a cost. So like leach, residue, and slag, and I get 3 extra items. So you define the percentage of the black mass that you're refining, how many tons you get of that are these items based on a percentage, and then those will have forward pricing right here, black mass byproduct. And if it's a cost, it'll be negative. And there's also, so on the OpEx 2 tab, you'll have places to put your cost per ton. So you don't want to put something here and also account for it here as a negative. You don't want to double count. So if you put it here, don't put it over there. If you put it over there, don't account for it here. So that's the byproduct of the refining of the black mass. And then finally, we also have a byproduct of the initial refinement. So this would be not the ones that you don't own, because you could also, those byproducts are going back to the source. But for these, where you're either getting paid to take it or you pay to process it, you own all the byproducts and products, obviously. And so that could create that initial refinement before you get to the black mass. Could have some things that you could sell: copper, scrap, aluminum, steel, plastic. This could be a cost: electrolyte, salt, solvents, and other items. So you put the percentage of the total tons of initial feedstock processed that results in these different things, and then you have forward prices for those as well. And again, here you can see these are our costs, these negative ones. Okay, and then finally down here we have accounts receivable terms. So you could do, I did it just super high level, so it's likely some of what you're selling you'll have to collect it 30, 60, 90 days on terms to whoever you're selling it to. So you could put the percentage of the total revenue that is subject to terms of, greater than 30 days. Otherwise, the other 25% in this case would just be collected in the same month you process it. So there's no offset or cash flow effect. Now for the 75%, you could put up to 3 different collection times from the moment you process it. So month 1 would be the same month you process it. Month 2 would be essentially 30-day terms, and then month 3 would be 60-day terms. So you could put how much you're collecting of cash when you make a sale up front in 30 days, 60 days. Now you can change these. You could make this 3 months and this 4 months. And that just extends the cash collection period even longer. And you don't have to put 50-50. You could say, well, I collect it all within 60 days, so I'll put 100% here and 0 here. So just know you can edit the month number. Each month represents 30 days. Month 1 is the initial month that you process, meaning no offset. And then the percentage of the sale that you're collecting in each of those months, and that will affect cash flow. You can see here my minimum equity requirement is 14 million, and that's if I were to collect 75% of revenue a little bit earlier with 30-day terms, you see now that goes down to 11. Or if I were to collect it all up front instead, now my minimum equity is 7.9. So that has a fairly big effect on the initial capital requirement, and over time it'll affect your working capital. So you can account for that there. And then over to the right, as you change all the numbers, your revenues, costs, all that, you can see here the effect on cash flow, total feedstock tons processed per year, IRR of the project, and min cash required. And so it's nice to be able to just see that there as you edit these numbers, instead of having to switch tabs, because this data is also available on the executive summary, and then in detail to be on like the monthly detail, annual detail. Okay, so that's the feedstock tab. Forward prices, we went over this. You're just defining all the different prices and how you expect them to change over time. Right now it's default to just equal the cell to the left of it, so as you change cells it'll change going over. Feedstock details, here's some details on the existing assumptions I have in here. Obviously these could change. You might have different feedstock sources. And if you want a modification, I do offer custom services if you wanted to add more sources besides these 4. It would take some time, but it's definitely possible. You just extend the columns and update all the relevant logic. OPEX 1 is going to be mostly SG&A. These are non cost of goods sold items. So there's 3 sections there. Also a percentage of total revenue that you want to pop in here if you need to account for anything else. These are not cost of goods sold or direct costs or anything like that. OPEX 2 is now for your direct factory overheads, cost of goods sold. So the top section does not have to be staff. Some of it might be staff, like supervisors, factory overheads, utility, lights, indirect fixed costs here. You could put, so that's the top section. You just put the start month of the cost type, the count. If it's just like a utility item or something, it could be 1. But if it's people or something else that has a count to it, you put the count. And then the starting annual cost here, and then the percentage change in that over time. And then if it is a person, you do payroll tax and benefits here. So that's the first cost, and this will be a cost of goods sold. You also have direct labor by work center, so this is another way to do it. So we did 33 possible items, and you could do the start month number of each of these, the operators per shift, shifts per day, coverage factor, annual wage, and payroll taxes, benefits, and an annual wage increase. And this all flows to the monthly detail. This will be in the cost section down here. So here's the first part that we went through. Here is, so this is direct. Oh no, here's the work center. So this is work center. the very first part is actually at the bottom of the cost of goods section right here. So that was the first part. Here is the second section, direct labor by work center. And then technically you could have multiple, you could model multiple plant expansions over time. You would just adjust your feedstock intake accordingly. You would update your OPEX if that changes. For this, you would essentially model the start month of your second plant, starting with the same. If it's the same crew type, you just have the same configuration and new slots, but you'd have a start month that's in the future. Staying with this top part, and then this would all be this. This is cost per ton, so this would just scale with the amount of tons you increase by. And your capex, you would obviously do a whole nother plant. So I'd try to make this big enough to do at least two in pretty good detail if you wanted to model starting a plant and then doing a second one over, because this is over a 10-year period, the model is. So it's possible if you want to, but it'll probably most likely be used for a single plant, battery recycling plant is my guess. Okay. So that's so OPEX 2. The other part here, we have other direct variable costs. So this, the initial feedstock refinement, we have to remember the electric vehicle batteries might have different pre-processing and refinement costs than say LFP batteries or Gigafactory. So for each section, we have up to 8 or 9 direct costs per ton. So this is cost per ton of initial feedstock that's coming in. So cost per ton applies to all 3 inbound channels. So this is applies to all of these 3 because you have to process it all. And we define the cost per ton for each of those sections. So each of those 4 types. So that's that. On the monthly detail, that'll just be the next section down here. Initial feedstock refinement. There's the 4 types and the cost per ton based on the tons. And you can see all this is separated out as you go up here in feedstock intake by intake type, and then you've got all the different revenue and logic here. This was quite the process to get sorted and organized, but it's been done very well here. Anyways, so there's those costs. Then we have cost to sell the black mass. So this is the black mass that you're selling directly, and cost per ton of that. And then you also have the cost to further refine any black mass down into further metals if you're going to be, more of an end-to-end recycler. So we have those costs here. So this would be all the black mass. Essentially, if we go to feedstock detail, it would be all of this here. So the percentage of yield from refining black mass. So it's this. So once you get it, you have here, you refine it down, whatever percentage of black mass you're refining further. So this row is what we're applying these to, and that will then have these costs per ton applied as well to cost. So cost per ton of black mass refined. And then we finally have cost per ton of products sold. So these would be, our outputs, our output metals of nickel, cobalt, lithium, etc. from these things have different costs for, packaging and logistics plus quality control testing. So these are all cost per ton, and you have each of the output types and what that cost per ton is. And we've separated it into packaging and logistics for the top section, and then quality control, because those could be different for the different product outputs. Okay, next capex. So we kind of went over this, but basically you just define all this is editable, but the main thing here is column E is the cost, G is the month of expenditure, and then H is the useful life, which will define the depreciation expense over time, which is just really going to affect taxes only. It's not in the income statement. It's not going to affect cash flow. This obviously affects cash flow when the cost actually happens. And you'll see in the monthly detail we zero out Here we start with EBITDA, which zeroes out the depreciation already. So we're getting a clean cash flow number for this. And you'll see it's all balanced out in the financial statements and the balance sheet, cash flow statement, income statement. Okay, where was I? So CapEx. I also added a construction loan. So here you can define if you want to borrow money to start, constructing, and you want to see how that looks over time if it's not all up front and you're paying interest only possibly on that for a period. So here the first draw month is automatically calculated just whenever, you see that this updates if you change numbers here. Um, put 50,000 how it was. You got interest only period, the interest only rate, and if you're switching to amortization, that's almost always going to be yes, and then what the amortization term is on that loan and interest rate on that. And all this then automatically calculates, flows over to all the financial statements, and it's simple as that. Uh, let me update that. It's not a line of credit, it is a construction loan. Okay. Then you have loan 1 and 2, which are just regular P&I loans, mostly operating loans if you want to define an amount there, the month that you draw it, and the terms. They're both work exactly the same. Cap table, pretty simple. So this is going to calculate the minimum equity required based on your minimum cash flow. So if you go to the monthly detail and see the running cash flow after accounting for all the assumptions, it'll find the minimum you get to, which is the minimum cash required. That pops in here, and then usually this will just be 100% common shares. Total share count is not really that relevant for startups that are using this. Essentially, you just want to say, of this 11.4 million, how much is contributed from investors versus owners. The total of these two columns, when you add them up together, should equal this total. I've just done a catch-all in overflow for investors, so if you just don't put anything here, whatever you don't put in the owner's side will then flow here. You can put in the percentage of profit share in column D, and again, if you add up these two columns, they should equal 100%. Here's your checks down here. And that's pretty much it. You've got IRR calculations for each row, cash in and out, based on the project cash flows. So 99% of people will just use these first two columns only and set this at 100%. Startup costs, these would just be other legal consulting costs that are not part of, you haven't accounted for elsewhere and you want to hit in period 0. Terminal value, only thing here on exit, you can define your seller broker fees on the exit value, if there is any, 2%. It'd be 2% of the 650 million exit value. Monthly detail, so this is where you see the waterfall of things happening. So you've got, initial feedstock intake by type. So this is total tons of EV battery, feedstock, total tons of LFP battery, and so forth. Total intake tons here. Then you've got tolling revenue, gate revenue. So tolling is when you're paid a fee, you take it, and you return it. You don't own the feedstock. Gate revenue is revenue you take in for receiving the feedstock. And then you've got feedstock refined to black mass here. Black mass yield from feedstock tons, and then of that, how much is sold directly versus how much is sold or converted into more metals, and the revenue of those accordingly. And we have different amounts of tons of metals that are yielded from each of these types, and then here's the revenue from that. And there's revenue from each of the 4 sources. Byproduct from refining black mass by type. So again, you're going to get these byproducts, and they could be different makeups for each of these types. And then the revenue from that. And and then the final byproduct from the initial intake of feedstock and revenue from that. Then we got a total revenue summary, all your indirect and direct costs. We kind of went over all of these. Total cost of goods sold summary, sales and marketing, G&A, R&D, loan activity. You've got your accounts receivable effects here on working capital, capex, taxes, exit proceeds, loan repayment, and cash flow. Annual details, the same thing, but on an annual basis. And here's our check to make sure it matches the monthly. You've got discounted cash flow analysis, which is going to show that minimum equity up front, and then any future cash, positive cash outflows after that would come into here. The total of this row always equals your cash balance at the end, so $1,080,000, and this should be $1,080,000 here. And then you've got your breakdown between investors shared versus owners based on the percentages defined on the cap table, the resulting IRR, and net present value. Visuals, you got total revenue, gross profit not including depreciation, EBITDA, gross profit percentage, cash flow. Oh, this is from the model it was actually sourced from. I don't think that's a relevant chart. We'll have to remove that one. EBITDA percentage. Let's move this over here. Annual capex. Total assets versus total liabilities. Annual revenue by category. So here's your tolling revenue, black mass sales, revenue by black mass byproduct, gate revenue, selling the metals. This is your main one, this middle one, and then revenue intake, feedstock, byproducts. Total assets versus liabilities on the annual view, monthly cumulative cash flow. So here's your break even when you go above the zero line here on your initial startup. Inbound tons by type, so how many tons you're intaking per year of the 4 different types. Annual tolling revenue by type. Gate revenue, annual direct black mass sales, annual revenue by metal yield type, annual EBIT per inbound ton, so how much you're making in EBIT, or essentially your profit per ton processed. Your average revenue per ton inbound, so this is top line, this is bottom line. And then average cost of goods sold per inbound ton, and then average revenue per ton black mass direct versus black mass refined. So this shows you, okay, it's clearly you're making way more on the refinement than the direct black mass sales. But there could be reasons why you're doing each, but this shows you a nice breakdown by year of that as well. Okay, and I'll have to update the order of these charts. Income statement just shows you all your revenue items, your direct cost items. So we're adding back depreciation here in EBITDA, your SG&A, depreciation expense, taxable income, net income. Income statement annual, balance sheet, and all these are connected. The three, this is a 3-statement model here. Balance sheet, cash flow statement, and that is it. Depreciation is just logic for the depreciation, and then the receivable logic here, because these are dynamic calculations. And that's it. So if you want to purchase, links in the description below. Let me show you. It's over here at smarthelping.com. It'll be in general industry, industrial sector right at the top here. It'll also be included in the industry specific bundle. It'll be included in the industrial sector bundle if you want. It's a little bit cheaper than the whole one. I'm also going to put it in the super smart bundle, obviously, which is when you purchase everything on the whole site. So it's obviously included in that. And if you want work or want custom work, you can hire me, $275 an hour. Remember, and I have a PayPal option where it has installment payments that could be helpful, and I'm pretty quick on turnarounds. 1 to 2 days, you usually get a pretty significant amount. Or if you need work every now and then, a couple hours a month here and there, that's fine too. Just email me, Let me know what you need. All right, and remember, financial models, I've done hundreds, bunch of different industries. Check it out. Industry specific, done a lot of recurring revenue things, real estate, underwriting, joint venture distribution models, and waterfalls, where you just plug in the numbers at the top and the terms, preferred return or IRR hurdles or what have you. General business valuation templates, accounting templates. Um, Lots of fun stuff here if you want to learn and get good with Excel and see. I've spent over a decade building all this out and working for clients. Alrighty, like and subscribe, and I will see you on the next one.